Hello, welcome back. So, Teladoc is a company that we have talked about in the past. It's one of Cathy Wood's favorite companies, which actually went down 36% in the pre-market right now, and we are expecting it to drop heavily when the market opens today. Now, the company has already been battered down excessively. I mean, look at this value here. It used to be around 179, and now it's getting close to 35 as the market opens today. And if you take a look at, let's just say, the 1 year period, you will see that it's all about going down. And the market chart tells you of a company that was going higher and higher for a while, and then it started going sideways. And you would kind of expect that. I mean, we talked about the company being massively overvalued in the past, and I always try to say that when you are buying a massively overvalued company, apart from the fact that you have a lot of risk, if it goes down a lot in value, you don't have anything to show for. So, for instance, if let's just say a company like Facebook goes down, they are still making tons of money. They are making insane amounts of free cash flow. Their business is booming. Everything is booming pretty much. And so, even if there is a little bit of a negative sentiment and the stock goes down for a while, you still have a company that is doing amazingly well. So you don't really care for this kind of fluctuations, really. But if you take a look at Teladoc here, let's take a look at the financials of the company and see if this is the same story with a company like Facebook. Now, look at this one. The PE ratio of the company is negative. Now, when I first see this, it's the first value that I see here, I know that net income is negative, and I hate to see that because the company is losing money. And if you are investing in a company that is losing money, what exactly are you investing in? And I have talked about this concept in the past. You can, of course, in some situations, buy a company not that is not making profit, but you need to have a very strict set of rules, and also you need to be risk tolerant. You need to want to take some risk. And the thing is, there comes a point where taking a risk is maybe a little bit foolish if you actually overpay for a company of that sort. Now, if you pay a very cheap value, then maybe it could be in some situations a buy. But this is where you need to do your due diligence and kind of check the finances of the company and whether it makes sense to invest. Now, this one also has a very high price to free cash flow ratio. And you may be wondering why this is positive when the P ratio is negative. And we're going to examine that. But this tends to happen a lot with non-profitable companies. Now, look at this outstanding shares count, 20% higher in the past 5 years. So the company has been massively diluting investors, selling stock as the company stock price was shooting higher. Which, if I'm the board of the company, it makes some sense because that's pretty much the only way I can make money. But if you're an investor, it's terrible for you because you bought one share back in 2017. It's almost as if you bought one fourth of that amount. So that is horrible. You have been diluted insanely. Now, the free cash flow to total liabilities also points to a company that may not be very solvent here because the free cash flow that they generated last year is it has to be used in order to pay the total liabilities, and it has to take 13 years of this free cash flow in order to pay these total liabilities if we wanted to, pointing to a company that has a lot of liabilities when you compare it to their free cash flow. Now, as you can see here, the good news is that the revenue is increasing, but with increasing revenue, you need at some point to be seeing increasing net income growth. And look at this, this actually goes the opposite way. And what's the good thing with that? There's nothing good about this. I mean, at least when you're getting increasing revenue, you need to start seeing some increase in net income. And you see the opposite thing here. The free cash flow is increasing, but again, there are reasons for this we're going to examine, and it's also close to zero. It's marginally positive. And the total equity growth here, almost 3,000%, because guess what? The company has been issuing shares like crazy. So it's basically shareholders that have been funding the company and not operations. And that is a very, very dangerous game to be in. Now, the debt to equity ratio is low again because a lot of equity, because of a lot of stock issuance, pretty much is what that means. But look at the net income is very negative here, super negative. And look at these returns. absolutely terrible here for Teladoc. And so just by looking at these values already, I'm almost, pretty much not taking any extra look in the company for a buy, because I just don't see it. I mean, there are terrible things going on here. Company is not profitable. It's not making good margins, pretty much negative margins, and not good returns. I mean, the outstanding shares have been increasing like crazy. It doesn't look very solvent as well, and they have basically been attracting shareholders, and issuing even more and more shares. So that's a terrible thing to see. Let's take a little bit of a closer look at the income statement here. The only good thing, the revenue has been increasing pretty much year over year, but look at the net income, the thing that we talked about earlier. It's going down and down. Look at this decrease over here. So insane how it becomes worse and worse. And of course, the total equity keeps increasing. Guess why? Take a look at the additional paid-in capital. It's coming from stockholders. It's not about the company's operations. And the clear way to see that as well is that the fact that it is not about company's operations is that company's operations yield negative here, yield a big negative in terms of their net income every year. And so from this, we're getting some stock-based compensation, of course, a little bit of depreciation, which is added back to the cash flow statement. And this is why this is a positive value, but it doesn't come from profitability. And this is a very, very important reason why my stock evaluation tool here uses the relationship between free cash flow and net income. And this is pretty much the free cash flow margin, is free cash flow divided by net income, not revenue, because I want to be taking a look at profitability, and I want this number, this free cash flow margin, to come from profitability. Now, the thing is, you see that being positive, but the free cash flow here is negative, and the net income is negative. And so this value being positive is already a bad thing, because both values are negative. It's just that the division makes it positive. I will actually probably even change things up a little bit in the tool, and maybe show this in red in the case that net income is negative and free cash flow is negative as well, just as an extra help for people who are taking a look at this. But what can you do here? Now, you can of course use some ways to determine whether a company is interesting for purchasing, even if it's negative in terms of profit. But this one, I mean, the net income that I'm seeing here is doing worse and worse, and the margins don't seem to be getting better. Look at this. This is just very, very bad. So what can you do here? The only thing that probably makes a little bit of sense maybe is to think that the company will achieve a marginal profitability and go like 1, 2, and 3% in terms of net income margin, and the revenue growth can be great. Let's just say it's 30, 40, and 50. Pretty amazing. In order to achieve that, it would probably have to be amazing anyway. And the free cash flow margin, let's just say that they achieve something that is typical, something like 80, 90, and 100%, let's just say. And we need an annual return of 13%. And I hit calculate. And even with this super aggressive scenario here, where the company is doing amazingly well, even then, the current price is very high. Now, the current price will be 34 or so when the market opens, in which case we would be near our high estimates here. But still, look at the values that I set here. The net income margin that I asked for is 1, 2, and 3%. And the company has been doing these income margins, net income margins, in the last 5 years. So pretty terrible. Yeah. So this company is definitely not investable. And I have made a video in the past, I think a couple of videos actually, about Teladoc. And I have always told people that it's a very, very bad idea to invest in a company of this sort. And so hopefully investors here didn't enter this sort of like trap of a company and avoided this weird like ARKK holdings like a Teladoc is, because it really doesn't make any sense to hold this company based on what they are currently doing financially. It can really, really kill your portfolio. So thank you for watching the video. I hope you enjoyed this one. Please leave a like if you did, and remember to subscribe, and I'll see you in the next video. In the meantime, take a look at the video that I made earlier, a few hours ago, and it was about Meta, what Facebook did in the earnings report, which was great because the stock is about 20% higher today. Thanks again for watching, and I'll see you soon. Bye bye.